Hi, this is Todd, and I've got a great case study for you here. It is an interesting because there's many different facets to it. There's a purchase that's going to be a second home, not like a vacation or a vacation property, but the client is selling the first house that they bought back in 2004, and they're selling it to a friend, and they're going to be buying a new house that they found, a much nicer house for $265, and they have some questions. One of the key questions that they have is, did they make a mistake the first time getting a 30-year fixed? Secondly, should they get a 30-year fixed this time or a 15-year fixed? They have some debts that they're wondering if they should consolidate at the closing table and pay those debts off. They also have an inheritance, which is what prompted this. They received $70,000 as an inheritance from a relative, and this made it possible for them to really consider buying a little bit nicer home, or a lot nicer home in today's market. And another big question is, do I put that entire $70,000 down as a down payment, or do I just put down maybe a 20% down payment, or do I use it to consolidate debt? What's the highest and best use of that money for this particular client? So a lot of stuff going on here. And I'm going to go through and show you how we put this case together and how we would explain this particular scenario, and how we explain this to the loan officer in question as how we would recommend them moving forward. So let's start off. We've got a purchase. So you'll notice the type of plan that we've selected here is a purchase plan. The contract price is $265. And on the add details here, we can see they're currently selling a house for $210,000. There's no commission because they're selling it to a friend. They had some friends who were interested in their house if they were going to buy it or going to buy another property. So that means that they've got $210,000 technically coming from the sale of that property. Now, they had $70,000 that came from an inheritance. So we look at this as, what's the total money available? What's the pot of money they could work with? They've got $210 from the sale of the house, $70 from an inheritance. That means they've got $280 total to work with. What's the purchase price of the house they're buying? They're buying this house for $265. They want to put at least 20% down, which means they're going to need $53,000 to put down. And if they put down $53,000, they'd be borrowing the balance of $212. So this is just our quick little summary here of the key details of the transaction. I called this plan title, Debt Consolidation to a 30 or 15. And remember, this can be a purchase consolidation. One of the things that's cool about the software is you can do a simple straight-up purchase-to-purchase scenario comparison, but you can also do a purchase and a debt consolidation together in one illustration. And we're seeing this come up more and more. People are buying a house, maybe they're trading up, maybe they're trading down, and they're wondering, how should we handle the debt that we have at this time? They have gross annual income combined of $135. So I just changed their name here, and they're in a 30% tax bracket, state and federal. This is what they're looking at. They have their current mortgage, and let's look at the details of that. The property's worth $210. They had a 30-year fixed on it before that they got with Bank of America. The original loan amount was $150,000. They began this 10/30/2004 at a 6 3/4 rate. They currently owe $136,180. They're currently paying $972 a month. So in their mind, this is a pretty low payment. That's one of their questions. Can they afford to go from a mortgage that's currently around $136, where they're paying less than $1,000 a month, up to something that's going to be a $265,000 purchase? It's an important question. We want to put in the property taxes and stuff here because that's what they're paying now. That's part of their current expenses. And we'll be able to compare that to their new expenses on the new property. They also have homeowners association dues of $25 a month that they pay in the neighborhood that they live in today. So these are all the liability details for that transaction. They have an auto at 7.28. They still owe about $30,000 on that. And they have 2 credit cards that they ran up for some school-related expenses where one of the spouses was going back to school, kind of books, tuition, things like that. And they could probably pay it off, but they have no other real cash. So that was one of the things about this situation I want you to keep in mind. This client had very little cash. Other than their checking and savings, we're talking money market, they had no other investable savings so far. So that was a concern they had. Did they use the $70,000 and just start a savings plan with it? or should they go ahead and take advantage of this property, which they believe at 265 represents a really good opportunity in the current market. So how would we go about setting this up? Let's go to the Borrow tab and let's take a look. Okay, so we click the Borrow tab. The first thing we see here is our current liabilities. I won't go through and explain this. I'm sure you're familiar with how it totals up the loan amount, the rates, the payments, etc. So our first opportunity here was to explore one of their questions, which is should we get a 30-year fixed again? And you can see right off the bat, we titled this 30-year fixed no debt. Because when we look at their current borrowing, 7.25, 8.9, 12.49, all of their borrowing is well above their new pre-tax and after-tax cost of borrowing. So there's no real reason for them to retain any of those prior liabilities. They're better just to roll those in, get those down to a much lower interest rate, especially given their secondary concern, which is cash flow and being comfortable with that cash flow. We then set up a 15-year fixed, again, also with no debt. So contract price is $265, 15-year fixed, 80% LTV. And we started there because the couple had no other savings. For them to come in and put down a much larger down payment meant that they were tying up more money into that house today. It's better off for them to consider emergency fund. If they did want to come in and put down a much larger down payment, then I would really want them to look at an equity line of credit just to have some borrowing capacity and some liquidity should they need it. So the way we recommended this is we recommend a 30-year fix with no debt and a 15-year fix with no debt. But again, you could set this up any way. You could set this up as a 15-year fixed with debt and a 15-year fixed with no debt. We used the third category for a competitor. They had a competitor offer from a builder who was part of this transaction, had a mortgage company, and they had offered them a 15-year fix because that's what they'd asked about at 4.375. So one considerable use of this fourth category, because I don't know that you always need to do 3 loan scenarios for a client, is use this as your competitor field. So we put it in the way the competitor had offered it. They simply had offered an 80% LTV at 4.375. They didn't look at the auto or the credit card or the other debt. None of that was really considered. It was more of your traditional, here's a rate quote, here's what we can do for you. But we can throw that in here, right? And we can say no, no, and no to paying off those debts because that's not what they had recommended. And this gives us a way to further differentiate the value of our advice over time. So when we go through and look at the transaction costs and how that would set up, we know they have $70,000 cash available. They're purchasing a home for $265. They're going to borrow $212, and again, that's coming from right up here. There's a 1% origination fee or points at $2,200 in closing costs. So I can see the total closing costs, the debts being paid off, and the cash needed to close is $238.7. Now, what is this $181,380? What's that coming from? Well, that's coming from yes, 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 and yes. We're paying off all of this debt. $181,380 is being paid off at the closing table. So they'll need $238.7 to close, but they have $280 available. Why do they have $280 available? Well, they had $210, remember, from the sale of their property, and they had $70 from the cash available. So the software is looking at that bucket of money to see this is what you've got available. So if you go with a 30-year fixed no debt, there's going to be $41,300 still left over for you at closing. Now, and I like that because, again, they could put that as a down payment, and they would have a lower payment, but they'd have no current cash. And they may need a little bit of cash for the move, for moving in. And also, this would be a great opportunity to consider getting them working with a financial advisor to start building up an emergency fund for some reserves. Now, here's the 15-year fixed with no debt. You'll notice that the cash at closing is exactly the same. This first question is, can I afford it at closing? Meaning, what's the cash impact? It's going to be the same if I do the 30 or the 15. Now, with the competitor, I can see there's a big difference here. If I went with their scenario, there'd be $86,325 left at closing. And that's because we're not paying off this auto or credit card debt. We're only paying off the current mortgage. But that's okay. I don't mind putting that in here and explaining that in the context of my conversation. If I want to go ahead and take this away, kind of show it and say, I've done the analysis, I have a better solution for you, but let's get down to what we're recommending. I can just simply shrink that up and all that competitor stuff goes away. But I'm going to expand it here to kind of show you how I would speak to what I was recommending as well as what the competitor offer was on the table. So you've got 70,000 available. Here we're leaving you with 41 versus 86. Okay, well that looks a little bit better. Now let's get to the second key question. What about the actual payment that they're going to be making? Well, they're currently spending $19.56 a month today to service all of their debt. If they go with this 30-year fixed with no debt, then their actual cash flow is improving by $503 a month. That's pretty engaging, right? So if you want to look at comparing the 30 to the 15, there's no way to know yet which of these is the best thing for you financially long term. If your only concern is cash flow, then this one's your best shot right here because you're going to have $503 a month left over in cash flow. If I go with a 15-year fixed with no debt, this is pretty cool. You can see that their net payment difference in terms of what they're paying today is they have an extra $2 a month in their pocket. So in other words, they can buy this house, pay off all their current debt, buy the new property, get a 15-year fixed mortgage. That would be their only debt. Their cash flow would be exactly the same, and they have $41,300 left over. So you're really doing you're doing a story selling opportunity here to talk about this in the context of helping this client make the right decision. Now this 86,325 looks really good, but you said you were concerned about cash flow. Your cash flow is going to go up. Your cost is going to go up by $700 a month if you get the new 15 and don't pay off that other debt. So right off the bat here, boy, this looks a little bit better here, but when I get down to cash flow, there's no question. If they don't want to have an extra $700 a month going out of pocket, they're going to be wanting to focus on the 30-year fixed or the 15-year fixed with no debt. But remember, this particular client, they were wondering if they made a mistake when they first bought their house and got a 30. Should they have gotten a 15? I don't have to answer that question. I can say, at the time, you probably did what you needed to do to buy that property. And fortunately, at the time that you bought it, even with a downturn, you still had some equity in that property, owning it now for 7 or 8 years. So what we really want to look at is going forward over your target time frame in this property, what's going to be the best decision for you? So we simply said, what is your target time frame? And their target time frame was 15 years. So we slid it over to 15 years. We asked about the property appreciation, and they felt like 2% was a reasonable appreciation rate over 15 years. So now we have the opportunity to look at this and answer a simple question. Which of these scenarios is the best scenario for this client over a 15-year time frame? Now, the house value, remember the current column is always your current column, right? If they keep that house that they're in today and it appreciates at 2%, it's going to continue to go up. But they're buying a house for $265,000, a much bigger house. If it appreciates at 2%, it's going to be worth more to them over 15 years. So we can see one of the benefits of the bigger house, there's obviously some downside, like you have more expenses, but overall you're going to get this higher appreciation on a higher property value. Now in 15 years, if I stayed where I was at today, I'd only owe $72,000, and I'd have a $70,000 amount that came from that inheritance. And that's of course without interest and appreciation, because we're not really focused on that yet. But this house value of $357,000, they'd still owe $141,000. Here they'd owe 0 and they'd owe 0. They have no other liabilities in either of these three, because at that point all the liabilities would be paid off. And I can see the cash that they had available, their opening balance for each of their cash accounts. So the equity here, when I look at just the equity, what's the equity? That's the net money that they have over time. The difference here is they have $23,000 less in equity on the 30-year fixed. They have positive $117 on the 15 and positive $162 with a competitor. But again, we're looking at what is the cost over 15 years? What's the real net savings? Does this make sense for them to do? And which of these makes the most sense? And we can do that with this one number right here, savings over 15 years. This is going to net it all out for us and say over 15 years, if you go with this 30-year fixed, pay off all your debt at closing, net, you're going to come out ahead by about $6,746. If you go with a 15-year fixed with no debt, kind of going with your gut here and looking at a 15-year product, your savings is $57,943 over that same 15-year period. Your competitor's solution would be a positive about $36,788. So I'm able to show here that not only is this the best financial decision for the client, but it's also superior to what the current competitor is offering that client at this time. Now, this particular client said that on a savings basis, they would tend to put their money in a checking account. So it's one of the reasons this 15-year fix looks better, because that money is just going to sit there in cash. There's another opportunity. If I were doing this, I would be recommending the 15-year fixed with no debt, consolidate all that debt, pay all of that stuff off, keep your cash flow almost exactly the same as it is today, work with a financial advisor or a professional to begin building some wealth for you and creating a savings account for you over time. And then we can monitor this and get together on a yearly basis and just see how we're doing, how we're tracking overall. So hope this helps. This is what we would recommend. There were a lot of missing pieces there. Should they go with a 15 or a 30? In this case, they want to pay off this mortgage faster, sooner than later. They were more comfortable going with something that would keep their cash flow about the same, that was also going to give them a way to jumpstart their overall savings account. And we can see financially, based on their situation, this was also the best decision for them financially over a 15-year period. The decision to buy or not buy the house is answered, right? Because in all three of these situations, they're better off financially based on their assumptions. And again, we can answer the other two key questions. Can I afford it? Yes, you have the cash. And yes, you have the cash flow. So hope this helps. Have a wonderful day.